Oh, hi, Lori.
Hi, how are you?
Good. I didn't hear you when I was just setting up my final
Oh, I
slide
think I
here.
was muted there. I didn't even realize it.
Oh, okay. Good to hear. Remember Jeffrey Toobin? He's the he's the legal guy, used to be on CNN, and he lost his
Yes.
job because he was doing something inappropriate. I never realized until maybe 6 months ago that when I leave you guys while you're here, and maybe I'm looking for a slide, you can see me, but I can't see you. So while I don't excuse the guy, I can certainly understand how he made the mistake. That is not a great legal mind. How was Easter, by the way?
It was fantastic. Yeah.
Oh, excellent, excellent. I bet you did some baking this weekend. Come on.
No, I told you I'm on a moratorium. I'm not
Really,
doing it.
even through the holidays, huh? Wow. Good for you.
I'm waiting for my birthday. Then I'll do some baking.
When's your birthday?
May 1st.
May 1st. Ooh, that's a nice date. Nice.
It is.
First of the month. Yeah, there we go. Come on now. Get this thing up here. All right, I must set this up. Okay. I haven't shared it yet. Can you see it, Lori, or not?
Not yet.
Okay, I guess I forgot to share it. I must share and share. Share. Chapter 7. Okay, now can you see it?
Yep.
Okay, except that's not the one I want. This is what we want here. Can you see that? It says accounting for cash, chapter 7, no?
It looks like it's coming.
Okay, hold on. Let me get this. This thing is like, oh, I think I have to do this. Try this now. All of a sudden, this thing doesn't want to respond. I click on the meeting button. Oh, okay, all right, here we go. New share. Okay, can you see it now finally,
There we
Lori?
go. Yep. Mm-hmm.
You know the bar on the bottom you have here to do controls with YouTube, with Zoom meetings? Somehow they ended up on the top. I don't know how they got up there. That's why. Anything to confuse the guy. Okay. So let me do this quickly. Try to get us out of here before 8 o'clock tonight, huh? Okay. All right, here we go. Accounting for cash. The first half of this chapter is really basic uh, knowledge that anybody getting out of high school should have. But it's also good to go over with college freshmen who perhaps have never opened up their own credit card or checking account, that type of thing. But then we get into the more interesting stuff, which is the bank reconciliations and the petty cash fund and the change fund. And these are things students seem to pick up fairly well. And let's see what we can do here. Can you still see the screen, Lori?
Uh-huh.
Okay. Okay, I'm having a Jeffrey Toobin moment here in terms of getting organized. Just give me 1 second here. Okay, here we go. Counting for cash. What's cash, ladies and gentlemen? Hey, we know it's currency and coins, it's checking accounts, it's checks, it's money orders, it's bank cashier's checks, it's traveler's checks, it's direct deposits, it's automatic withdrawals. It is credit cards. Credit cards are cash, okay? Cash plays an important part in running a business. Who knew that, huh? It must be carefully managed and controlled. So we talk a little bit about internal controls. Internal controls, this is a two-word term that talks about the policies and procedures that are designed to ensure proper accounting. So with cash transactions, Lori, you should put the money in the bank every day. Every day. And
Bob, I'm going to
maybe,
interrupt you for just a moment.
sure.
I am still on the first slide, so your other slides are not going.
Okay. All right.
Sorry.
What are we doing wrong here? Okay. Are you okay? All right, let me do this. Let me just close it real quick. Just take a second.
Sure.
Ladies and gentlemen, we have technical delays here and new share. There it is right there. Now, do you see that counting for cash?
What I'm seeing is the blue screen, the Chapter 7 accounting for cash. It's not going through. I see your thumbnail.
Okay. Oh, my bitten nails, huh? Okay. Now, you see, now it's blown up, right? You see the Cengage book on the left? Okay.
Yep.
Let me just go through a few slides then. Am I sliding
Yep,
through okay?
Yep.
All right, here we go. Boy, we really have to cut out the first 5 minutes of this. I hope Cornelia doesn't look at this one. One time, I meant to cut out the first 5 minutes of like a 1 hour speech, and I accidentally cut out the last 55 minutes.
Oh.
So I don't want to make that mistake again. Cornelia was pretty miffed. Okay, we know what cash is, okay? It's a wide range of coins and checks and credit cards. Internal control. If you run a business where you're bringing in cash, you know, a store, an auto shop or something, you want to get into a habit of putting the money in the bank daily, and probably not at the same time of day. The reason is you don't want to have money piled up in your business. I mean, every time you turn on television to watch Law and Order, half the crimes are a murder where somebody got fired from a fast food joint and knew they put the money in the bank on Friday night. So, you know, that's an example of an internal control. All disbursements, try to make them by check if you can, right? You start paying out a lot of big bills with cash, that just invites trouble. Describe how to open a checking account. You have any questions on this, Lori? Have you ever opened a checking account? Okay. Well, listen in with the rest of the class and jump in when you want to correct me on something, okay? How to open a checking account. To the rest of the class, this is pretty basic stuff, but let's go over it just a little bit, okay? The USA Patriot Act. Every bank must have a customer ID program that provides clear identification of every account holder of the bank. So banks now have 3 numbers that work in favor of the consumer. You know, it has your checking account number. It has your transit ABA number, which is what you can use to wire money. And now it's got this Patriot Act number. But you could still come up with a lot of ways to commit fraud. Open a checking account. You're going to have the authorized person, which is you, to sign checks. And you're going to sign a signature card, probably at the bank in front of somebody. They're going to take your fingerprints, I bet, maybe even take a picture of you. And then they're going to put that card on file if they ever need to verify your signature. If you left your paycheck on the street and I picked it up and tried to cash it, they would look at my signature on the back of the check right away and be able to put me in jail. The card also includes taxpayer identification number. It's going to have your social security number and the business number, like you probably have for your business, right, Lori? Okay. A signature card. Boy, that's old-fashioned looking, isn't it, Lori? But I think you still probably have to fill something like this out in hard copy, at least for the signature. But this is going to be a long thing, class. It's going to have a lot of stuff on it. It might even ask for password type information, like what was your first pet, your mother's maiden name. Maybe not anymore, but that's how it was, and may still be in some areas. Make a deposit. You fill out a deposit slip. Each check is identified by the ABA number we just talked about. That's that 9-digit number that comes before your account number on the, they're saying here, found in the upper right corner of each check. My experience is on the lower right corner, but
yeah.
What do you think on that one, Lori?
Yeah, I've never seen it on the top right.
Yeah. Well, you'll find it, class. It'll be there.
Yeah.
and it has the type font of magnetic ink. I'm so sorry, Lord. It has the type that looks like magnetic ink. It's tough to miss, but it's something you kind of have to realize is there. I have a problem where I need to wire money once in a while, and if I don't have that transit ABA number, it is impossible to do anything. A deposit ticket. Here we go. You list everything separately, added them up. Maple Consulting. Oh, that reminds me, I got my paycheck the other day in my pocket here. Okay. As you all know, when you get a paycheck, if it's not direct deposited, you have to sign the back of it to make it negotiable. And it can be your signature alone, or if it's a business, you might have a stamp. You got the old stamp going, Lori? You just sign them?
Nope.
No stamp. Okay.
I remember those, but.
Yeah. Business commonly uses a rubber stamp, Lori, and get with the program, huh? So the endorsement can be as simple as just writing your name on the back of the check. The problem with that is if you do that before you, say, set out on your trip to the bank and you lose the check, anybody can pick it up and try to cash it. Hopefully there's some safeguards that will prevent them from doing it, but really this happens all the time. If you just put your name on the back of the check, do that when you get to the bank. Do it when you're standing in front of the teller. You're risking theft otherwise. And what we call that is a blank endorsement. You just sign the back of the check. That means the check is payable to any bearer, okay? Now, that doesn't mean that someone could just find that check on the street and walk into their bank and cash it. There could be some safeguards that would protect you there. But a blank endorsement. Now, you might be wondering why I'm spending so much time on this part of the chapter, because these are a whole bunch of multiple choice type questions. What's a blank endorsement? What's the next one? A restrictive endorsement. A restrictive endorsement protects you a little more because it adds some requirements to be able to cash the check. Restrictive endorsement, the payee, that's you, adds words like for deposit only. I got into that habit 50 years ago. And I still do it, even though I don't deal in checks too much anymore. Everything's online. But yeah, you put deposit only on it. And then you could even say, pay to the order of Santa Barbara Bank and Trust. Pay to Bob Smagula is always good, okay? So the restrictive endorsement, that's going to make it tough for somebody to take that check away from you. And they're just showing you here. You got the stamp. And you're right, Lori, the stamp is pretty old-fashioned, I think. Now, here's a tough one. Do you guys know what an ATM is? I bet you don't. It's one of those machines. I'm only kidding. The ATM. We use them all the time, huh? Those machines that spew out $20 bills when we want money out of our checking account. And you have a PIN number, which I bet you know, 4-digit PIN number. Automatic teller machines are on a system that allow non-customers can use it. Anybody can go in there who has money in the bank. Of course, if it's not your bank's ATM, you have to pay a fee ranging from $2 to $3, $4. It's important for the depositor to keep an accounting record of ATM withdrawals and deposits. Now, that seems pretty obvious, but I don't do that. You know what I mean, Lori? Do you really, as soon as you take $20 out of an ATM, do you get that written right into your checkbook or?
Never. I don't even keep a check register.
You and I are terrible for this class then. Yeah. But for those of you who don't have automatic withdrawal of the money, if you have a checking account, you go in there and you take out $50 or $40. It's easy to forget about it. And then at the end of the month, you think you have $50 left and you don't, and you write a check for 30 and now you're bouncing checks. Speaking of writing checks, a check is a document ordering the bank to pay cash from the depositor's account, okay? Now, again, these three terms here, drawer, drawee, payee, it's snoozeville, right? But know what they are because it'll be on the test, okay? The drawer, that's the depositor who orders the bank to pay the cash. That's you. You are the drawer. The drawee is the bank. and the payee is the one who actually gets the money. The depositor who orders the check to pay the cash, that's the drawer. Drawee is the bank. The payee is who it's made out to. Business checks often have a check stub. Otherwise, a check register is used. Steps in preparing a check. They recommend you fill out the check stub. Another way to say it is you enter the check in your accounting system before you print the check. In fact, any accounting software worth its beans will not let you print a check until you've entered it into the accounting system. Okay? So you got to pay a check $100 to somebody. You go in there and you go into your purchase journal, perhaps, or cash disbursements journal, or just a journal entry. You write the journal entry, then you post it, and then you go back in where the program says, do you want to pay it now? And you go, yes, yes. Enter the date, the payee name, authorized signature. The check should not be signed until the check signer has verified that all aspects of the check are correct. Check your work. Here's a check with check stubs. Check stubs. God forbid, no one's going to understand this little bit of humor, but there was a pitcher in Major League Baseball for many years who the Yankees used to bomb. They used to murder this guy. He was a good pitcher, though. His name sounds like Chuck Stubbs. It was Chuck Stobbs. So if anybody in the class can tell me who Chuck Stobbs was, that's an extra 2 points, okay? Anyway, look at what we're looking at. We're looking at a check register, huh? Maple Consulting had $3,625 in the bank. They wrote a check for $3,000. Whammo, they're down to $3,325, etc. Bank statement. Now we get into something, bringing us up to some accounting, huh? Getting near the bank reconciliation. Bank statement issued by the bank once a month, and you should reconcile your bank account every month. And I'm picking on Lori here. Do you reconcile your bank account every month?
More or less.
The business?
My personal bank statement account, no, never. The business, I don't do it every month.
Okay. You're like me and most people who don't reconcile the bank statement every month, but it's really, really a most important thing, and it's certainly crucial in the business world. Without preparing a monthly bank reconciliation, you may be the victim of fraud and theft right now and don't know about it, and won't realize it until it's too late. Okay. So you get a bank statement, and it'll be as of a certain date. It'll show the balance at the beginning. It'll show the deposits and other amounts added. It'll show the checks coming out, and they'll be in separate columns, separate sections of that bank statement if it's done properly. Other amounts added during the period. That could be interest income. Maybe the bank collected on a note from somebody. They paid the bank directly. We don't know about it. Other amounts subtracted, maybe interest expense, a bank fee, and then our favorite, a bounce check, okay, an NSF check. And then it's got the balance. So we're going to take that ending balance in that bank statement, and we're going to see that the bank had a balance of $10 at the end of the month. Our checking account says we have $10,000 at the end of the month. That does not mean there's a problem. Does not mean there's a problem. There could be, excuse me, Larry, there could be checks going out in the mail. How can you lose a bottle of soda? Hold on one second. This is awful. I get this little cough in my throat. Yes. Okay. You take the balance in the bank, compare it to the balance in the checking account. Any difference in the number is not necessarily a problem. There will always be a difference because of items being mailed back and forth. So with the bank statement, you're going to get your canceled checks. Banks don't do that anymore, I don't think, unless you request it, I believe, Lori. Mm-hmm. You'll get maybe a copy of them with your check bank statement. And you can even tell the bank you don't even want that, if you want to save a little paper. Any other forms representing items added to or subtracted from the account. It'll be the detail. It'll have the beginning balance and all the detail. Here is a bank statement. A bank statement. Wizard Bank. And let's see what we have here. Sometimes the banks summarize it at the beginning. 27/21/51. Apparently you had a couple of deposits, and you had deposits totaling $25.99. You wrote 17 checks or withdrawals, 3572. There's your balance at the end. The bank statement will always start with the beginning balance here, where it says 10/20 beginning balance. Kind of an odd day to start the bank cycle, but okay. And then it's going to have the deposits. It's going to have the withdrawals. And if it's a check, it'll say your check number. So you can compare it to your general ledger, to your checkbook. If it's a deposit, it will at least have a date on it that you can verify. Here is an electronic deposit. You may not have recorded that yet on your financial statements because you didn't know about it. You did not know that on 11/3, a customer didn't pay you. They sent the money directly to your bank, which is even better. Notice over here, they have the dreaded debit memo, NSF check, non-sufficient funds check, non-sufficient funds. That's another deduction. And then we get down to the end there. And let me just do something here real quick. And then when we get down to the bottom here, here is our ending balance, 1748.09. This is going to be the starting point for our bank reconciliation, huh? Let's see what we have after this. Here we go, preparing the bank reconciliation and related journal entries. Bank reconciliation can be a little tricky at first until you just kind of get the sense of who's telling who what's going on. Where I worked, Laura, you might appreciate this story more than the rest of the group listening. But I had a wonderful accounting staff for many years in downtown Los Angeles in the factory where I worked. And it was an Asian gal. She was so wonderful. Nancy, her name was. And she loved to do the bank reconciliations. To her, that was like me watching a ball game. She just loved to do them. And every year we had a fight with her and the auditor when the auditor said, you can't have the same person do the bank reconciliations every month. Mm-hmm. And she would go nuts at the end of the year. But it was, the point is, these are kind of like a fun little puzzle if you want to put the best spin on it. On any given day, the book balance, the checkbook balance is going to be different than the bank. Your general ledger will always have a different balance. On any given day, the balance in the cash account, the books, is unlikely to be the same as the bank books. Well, you could have a difference due to errors, but it's really mostly by timing. Timing. Transactions generally are recorded by the business at a time that is different when the bank records them. And we're going to talk about two things. We're going to talk about what's called deposits in transit and outstanding checks. So we have this big difference between our balance on the checkbook and what the bank says we have. We must reconcile now. We must, on this bank reconciliation template you'll see in a moment, we must tell the bank, on paper anyway, we must tell the bank things they don't know. The bank tells us things we don't know through the bank reconciliation. Okay? All right, here's an example of what we're going to call a deposit in transit. On April 30th, you got a check in the mail from a customer, and you went into your system and you wrote an entry and you debited cash, 600, and you credited maybe accounts receivable. So on April 30th, that $600 is sitting in your April financial statements. But you mailed it to the bank. The bank didn't get it. They're saying May 1st. The bank might not have gotten it until May 5th or so, right? So that $600 is not showing on the bank statement. That's called a deposit in transit. A deposit in transit is a check we received from a customer that has been mailed to the bank after we've recorded it, okay? The depositor's book balance would be 600 more than the bank. And on our bank reconciliation, we're going to include that on the bank side. Here is a check, here is an outstanding check. They're talking about, we wrote a check for $350. April 30th, it decreased our cash by $350. But again, the person who got the check didn't take it to the bank until 3 or 4 days later. So that's called an outstanding check. Outstanding check. An outstanding check is a check we wrote that the bank has not processed yet. Deposit in transit is a customer check we received that has not gotten to the bank by the end of the cycle. And here are the terms: deposits in transit, deposits that have not reached the bank or been recorded by the bank before we do the statement, okay? Outstanding checks, checks that have been issued, those are the ones we've paid, but have not been cleared by the bank, not been presented to the bank for payment before the statement's prepared. So to that extent, we're going to have a difference between the bank's balance and our balance. And the bank might have a whole pile of service charges. They might charge us, like they're saying here, for check printing. They might charge us per transaction. They might charge us a fixed fee every month. They might charge interest expense. And you can also have positive or cash receipts stuff coming through the bank. Like I said, a customer paid us directly to the bank, interest revenue, things like that. Collections. What they're doing here, they just started us off with deposits in transit, outstanding checks, that's pretty easy, and service charges. And now they're giving you some examples of collections. Monies that the bank got, we don't know about. Wow, look at this. Somebody paid the bank directly. Where you charge accounts made by the bank on behalf of the depositor. Some businesses set themselves up that way. They tell the customer, just wire the money to the bank when you get it. Non-sufficient funds check, checks deposited but not paid because the drawer, the person trying to cash the check, did not have sufficient funds. NSF checks are the checks that our customers wrote. NSF checks are not ours. We're not going to get involved in that, okay? NSF check, that's a real problem. You got $1,000 check from somebody today, and you put that $1,000 in your bank account, and then you started to spend that money, and then a week later, you got the bank statement, and to your horror, you find out that the check bounced. The check bounced, meaning that this person never had the $1,000 to begin with, so the bank naturally took the $1,000 away from you. You never should have received that money. And another thing that can affect us are errors made by the bank or by the depositor. Now, again, if you're in my class, in the classroom, I would never give you a problem with errors made by the bank, although they're no more difficult to handle than errors by the company. But 99% of the errors involved in the banking world are not going to be the banks. It's going to be the company doing something wrong, transposing a number or not recording something. So these are just some of the terms we're going to talk about. Now, here we go. Preparing a bank reconciliation. Identify the deposits in transit. Identify the outstanding checks. What you're going to do is you're going to have the bank statement sitting in front of you, and next to it, you're going to have the general ledger account cash with all the detail. So you've got the detail for the company sitting side by side with the bank statement, which is the bank detail. And you're going to go to the first deposit that you have in your checkbook. And you're going to say, okay, on June 3rd, we had a $40 deposit. And then you're going to look at the bank statement. And if you see it there, you just X them out, you cross them out. If you see an item later in the month, $200 deposit you recorded, you don't see it on the bank statement. You have to assume that it's in transit to the bank and must be listed on the bank reconciliation as a deposit in transit. So you got to identify the deposits in transit, identify outstanding checks, and that can be a long job doing it manually, depending on the company. And of course, you're looking for errors. We meant to pay this person $189, and we accidentally paid them $981. That type of thing, okay? And any differences between the bank statement and our checkbook is called a reconciling item. A reconciling item. One party, it was not privy to this information at month end. Identify deposits in transit and related errors. Compare the bank statement with last month's deposits in transit. They should all be on the bank statement. If not, it's a deposit in transit. So what they're saying, and let me just back up a second. I didn't say that quite right. What they're saying here is you have to look at last month's bank reconciliation to make sure that the deposits in transit from last month have cleared the bank this month. If they have not, you have to keep carrying forward as an outstanding deposit in transit. Deposits listed in the accounting record, if not on the bank statement, we're going to call it a deposit in transit. And individual deposit amounts in the accounting records, if they differ, the error needs to be corrected, okay? That's us transposing a number. We wrote a check for 27 when we met 72. So first thing is, get a load of those deposits in detail. You do the same thing with the checks. You're going to sit there with pen in hand and you're going to say, okay, check number 35. We wrote it here for $50. Uh-oh, it's not on the bank reconciliation. That means that it is in transit. It is an outstanding check. This is a check we wrote. And outstanding checks can remain uncashed for a long time. We've had that experience, right, Lori?
Mm-hmm.
Nancy, my dear accounting lady, she used to get so mad when one of the, a salesman, for example, he turns in an expense report where he spends $1,000 on a business trip, and then he gets a check, $12, because the company owed him $12. That $12 check would usually be put in his desk drawer and forgotten until Nancy started yelling at the guy. Mm-hmm. Okay. The point is, the outstanding checks, they can, back up. If it's an employee of your company like that, you just kind of want to urge, will you please cash that darn check, or else we're going to void it, that type of thing. But you have to keep looking at the old outstanding checks and the old deposits in transit. Now, when I say you're sitting there with the bank reconciliation on one side and not the bank reconciliation, but the bank statement on one side and the checkbook information on the other, what I really mean, you're going to go into your system. QuickBooks. A lot of us have seen QuickBooks. QuickBooks, you're going to go in there and you're going to hit the button that says, I want to do a bank reconciliation. And QuickBooks is going to bring up all of your information. And now you might have a hard copy of the bank statement and you click off the ones that have cleared the bank. What's left over should be your reconciling items. Or you might even go further than that. You might have a deal, QuickBooks might have a deal with the bank where you can see the bank information online, just like theirs, just like yours was. That makes it a lot easier to reconcile, okay? Compare canceled checks. You need to check errors, check mark. Checks written but not cleared or outstanding checks. Now, you could have other reconciling items besides deposits in transit and outstanding checks. Not all of the reconciling items are due to timing. They're due to things that the bank did that we don't know about. The bank did something, they took money from us or gave us money, and we don't know it at month end. What are we talking about here? Credit memos. Not going to worry about the words debit memo, credit memos, but a credit. A customer paid us interest income. Okay. Some kind of cash receipt. Maybe somebody paid back a note. That type of thing. We're not going to know about that until the end of the month when we get the bank statement. And again, the debit items are the things that reduced our cash unexpectedly. Bounce checks, interest expense, bank fees, all kinds of things. Oh, how about this, Lori? Finally get to see some numbers, huh? So we're going to be bouncing back and forth a little bit with Maple Consulting, okay? And they're starting us off with an easy one here, where they're giving us some information that normally we have to dig up. And don't worry, when you do the homework, you'll do some digging, okay? But let's just get the basics down here. So we have a bank balance. I remember the number, 1748.09. And I also don't think they give us the beginning balance of the general ledger till we look at the reconciliation, but that's okay. Okay, so we had a beginning bank balance of 1748.09. We went through the deposits in transit, or rather say it more clearly, we went through our deposits one by one and compared them to the bank. One of those deposits that we made on November 21st had not been received by the bank. That is a deposit in transit. And you have to list that on the bank reconciliation. And look at this. We had check numbers outstanding, 219, 224, 227. The amount of these outstanding checks is going to be subtracted from the bank statement balance. So let me skip ahead and let's make this much bigger. Okay, that might be perfect. Take a look at the bank reconciliation. You're going to have one section that's called the bank statement balance. And after you consider all the reconciling items, you're going to add and minus as necessary. And you're going to come up to what we're going to call an adjusted bank balance. The bank statement piece is quite easy compared to the company one, because it's always this formula. It's always the beginning balance plus deposits in transit minus outstanding checks, and you're done. Here they throw in that the bank made a mistake. I'm not going to worry about that. But let's see what we have here. We have a beginning balance per the bank statement, 1748.09. They just told us about the 637 on the prior page. Remember checks 219, 224, 227? They add up to 292, 1748.09, plus the outstanding, or let me say it correctly, plus the deposit in transit, minus the outstanding checks, gives us a reconciled amount we call the adjusted bank balance, okay? We did that. We are still not going to be in sync with the bank, because all we did here was tell the bank on paper things they don't know. The bank doesn't know that deposit's in the mail, nor those 3 checks. So we're telling them on this worksheet here. Let's see what else they tell us. Let's see what else. Okay, here we go. Check number 214 was written for $18.98. What it was entered in the check stub and on the books is $19.88. Now, this could very easily happen if you're writing manual checks. Most business checks now are done by the computer. So it makes it a little less likely. You're more likely to make this kind of mistake if you're writing as opposed to entering, but it can happen. Okay, let's see what happened. The check was written for $18.98, but we wrote it on the check stub. On the books is $19.88. Hey, good news. We found out we have 90 cents more than we thought. That's exactly what that's telling us. So let's see what we got down here. And I'm going to be zooming back and forth a little bit. We did the bank balance, adjusted bank balance. Here's the book balance, okay? And what do we have here? We have an error on check. We have an error on check 214. Was that the one? I'm so sorry, guys. Let me go back. Yeah, it's a 90-cent error. Check 214. Oh, now I can finally read it. That was my bad eyesight, guys. And forgive me for bouncing back and forth, but we don't have too much choice. That 90 cents, Lori, that's money, that's found money, right? Mm-hmm. We wrote a check for 1988, or at least we entered it in 1988, but we actually wrote it for 1898. Month end comes, whammo, we found 90 cents more than we thought we had. So it looks like here that that's all of the pluses we're going to have. But let's look at the last three deductions. Maple made an ATM withdrawal of $100 for personal use. The boss went to the ATM, took $100 out, put it in her pocket, and you didn't know about it until you got the bank statement. So that's going to reduce our book balance. And then we got a bounce check, an NSF check of $200. That's money where we debited cash, probably credited accounts receivable, and we think we have $200 there, and we don't. And then the bank charged us $1.80 for a service fee. That's a pretty cheap service fee, huh?
That's a really cheap fee.
That'd be nice, huh? So there we go. ATM withdrawal, 100. And I see a 200 bounce check and $1.80. You're going to see the detail right here. Take a look at it. The balance for our general ledger was $293.23. We just have to accept that on faith. They didn't tell us that in any of the prior slides, okay? Well, we get to add back that 90 cents, and now we have these different deductions. Here's the ATM withdrawal. That has to come out of our cash balance. Here's the bounce check. That's $200 we thought we had and we don't. And here's the bank service charge. Now we take the balance per the books, add all of the increases in cash, subtract the decreases, and we come to a number, 209,233. You see that, Lori? They come up with the same adjusted bank balance. That's the whole point of the bank reconciliation. It is a super important thing that all people with checking accounts should do, and all companies should do. When you've reconciled, this gives you peace of mind. This tells you that you can account for every penny of cash movement over the past periods. At this point in time, at the end of this month, you have complete control over your cash movements. You know what you need to do to make corrections. And most important of all, you don't have to worry if this bank balance is unbalanced. Lori, I'll ask you again. We have an adjusted bank balance here of $2,092,000. I'm thinking big, okay? You do the bank reconciliation, and at the end of the month, you don't come up with an adjusted 209.2. You come up with an adjusted just $92. That's a big problem. When you say, you're going to the boss, I got a little bad news. We're off by $2 million. And the boss says, that's got to be a big, obvious mistake. Just go out and talk to Bob. He's the guy who handles the cash. You go out to talk to me and you go back, Bob quit today. You know that money's stolen. You get the idea. That's why the bank reconciliation is super crucial. The company that hired me up here 22 years ago, Jocelyn Electronics, across from the Jack in the Box on Hollister by the Camino there. when I got there, they hadn't done bank reconciliations in years. And we never could get them reconciled. The only thing we could do was open up a new bank account, let everything clear out the old. And that's just terrible, terrible. But I digress. Okay. Yeah. So let's go back to the bank statement one more time, because there's a little more I need to review with you. You see the bank statement side? It goes down to the first arrow, 209233. Outstanding checks, 225.67.78. Deposit in transit, 637.02. No journal entry is required for anything on the bank side of the bank reconciliation, because we're simply telling the bank things the bank doesn't know. We've already recorded these checks. We've already recorded that deposit in transit. So we don't have to do anything on our side in terms of a journal entry. But any reconciling item on the company side requires a journal entry. Let's call it an adjusting journal entry. What we're doing here is, okay, we had a balance in our books at the beginning for $23.93, and we found out we had 90 cents more. We have to write a journal entry, Lori, to debit cash and maybe credit accounts payable. It depends on what the check was used for. Mm-hmm. So here we're going to debit cash. Now the bank is telling us, look, your boss took $100 out. You didn't know about that. Here's a bounced check. You do what you want to do with it. You don't have this money anymore. And the bank charges $1.80. We are going to credit cash, credit cash, credit cash. On the ATM withdrawal, they told us it was drawing. You get a debit drawing, credit $100 cash. NSF check, you're probably going to debit accounts receivable and credit cash, because when we receive this money from the customer, we likely debited cash and credited AR. So now we're reversing it. And here we got a bank service charge. We're probably going to debit an account called bank charges or bank service charge or bank fees or something. Then when we've written those journal entries, we are completely done with the process. Bank reconciliations. Only two kinds of items appear on a bank reconciliation that require journal entries. Things we don't know. Things we don't know. Errors that the bank is telling us, and additions and deductions that don't appear on the books yet. They're going to all come from the bank statement. All items in the book balance section of the reconciliation require a journal entry. And understand that concept very clearly. On the test, you're going to get questions along the line is, the Johnson Company learned that there was an NSF check of $200 and outstanding checks were $200. True or false? You need to write a journal entry to cover both of those. The answer is no. The deposit in transit is something the bank is telling us, something we are telling the bank. Bank reconciliation, huh? Look at your journal entry, the 90 cents. The 90-cent error occurred when the check was written for a higher amount than it really was. So that's not so tough. You debit, in this case, you debit cash and you credit AR. The journal entry for the ATM withdrawal. There it is, $100. Credit cash. The bounce check. Bounce check, we assume it's from a customer. And we're going to put it back up into accounts receivable. And we're going to call this customer up and give him a piece of our mind. We're gonna raise our Irish temper, right, Lori?
Yeah.
I told you a million times, my mother was from Ireland. Journal entry for the bank fee. Remember I said you could have an account called bank service charges or bank fees, whatever. This company says, it's such a small amount, we're just going to call it miscellaneous, okay? True or false, everybody? Every single adjusting entry that comes from a bank reconciliation will either debit or credit cash. The answer is yes. Yes. All journal entries from the bank reconciliation represent an adjustment to cash. I don't know how many times I get journal entries like on the bounce check where they say debit accounts receivable, credit services rendered or something. No, you have to have cash in the journal entries. Electronic banking, I'm not going to talk about this. Okay. Hey, let's have a little fun with petty cash, okay? Petty cash. And could you give me 1 second, Lori?
Mm-hmm.
I just want to see if I can find this. If I don't find it in a minute, I'm not going to force the issue. Never mind. I just realized I'm not going to be able to grab it here. Okay. Okay, you can still see the screen, right?
Yeah.
Petty cash. Do you have petty cash at your place, Lori?
No.
Yeah. Some businesses don't need it. Petty cash. This is typically the classic. There's a little metal recipe box type thing, a little tiny metal box usually. And it might have a $200 balance. In other words, at the beginning of the period, the custodian who's ever in charge of petty cash, he or she has $200 in there. It'll be in there in the form of some $10 bills, $5 bills, ones, and a lot of coins. Petty cash. All we're doing with petty cash is paying these little tiny nuisance and nits that arise in the course of a business day. The mailman comes and he said, I have a very important letter, I think, here, but you owe me 45 cents in postage. Well, you're not going to say to the mailman, okay, take that back with you and we're going to cut a check to you next week. No, you're just going to give the guy 45 cents out of petty cash. You are not going to write a check. And when you hand them that money, you're not even going to write an accounting journal entry. What you are going to do, though, is have this guy sign a receipt for 45 cents. And you put that receipt in your box. And it's only at month end that we record the petty cash. Petty cash. It's a fund set up for small petty items. Checks for very small amounts are inconvenient and inefficient. So what do we do here? To establish the fund, a check is written to the petty cash custodian for the amount, and that person cashes the check and puts the money in there. The custodian should be the only person authorized to make payments from the fund. Typically, where I work, the receptionist would be the petty cash custodian or one of the accounting clerks. And think of it this way. You write that you have a $200 petty cash fund that you're just starting. So you debit petty cash and you credit cash. You make that first check out personally to the petty cash custodian, and she will go to the bank and cash that check in the appropriate combination of coins and bills. She will come back to the office, put that money in the petty cash box, lock it up, put it in her drawer. And when somebody needs to get paid with a small item, she's the one who will do that. At the end of the month, you are going to add up all of those receipts and then write the appropriate entries to record. Debit postage, debit COD, debit stationery supplies, debit refund on the soda machine, that type of little stuff. The custodian at all times should have $200 in that box. It's always 200. It's 200 cash plus the receipts, okay? Now, we're setting up the fund originally. We decided, Maple did, Maple wants to establish a $100 petty cash fund to be used to make small purchases. So look what they did here, everybody. They debited an account called petty cash and credited cash. So now you have two different cash accounts on your general ledger. You have petty cash and you have the regular cash, operating cash, I guess we can call it. Once you debit petty cash, you will never debit it again. Never, unless you choose to increase the limit above 100, okay? So here's how it works. Here's the classic petty cash voucher. And I bet this is the same today, despite all the electronics. Someone comes in. Jim Maple came in, and he said, I went to a client lunch. I had lunch with a client. Please charge this to my travel entertainment expense, $25.75. You hand him the receipt. He signs it, and then the custodian, Tina, I can't read that, blank. Tina Blank. Oh, very funny. Tina Blank is the in charge of the petty cash, the custodian. So you're going to come up with these receipts, and on that receipt, it'll have the name of the payee, the amount of it, the amount, the purpose, and the two signatures. Petty cash payment records. Now, what you're going to do in petty cash is you're going to have a what's called a petty cash reconciliation report. And it's going to be a pre-printed item. And you're going to have a beginning balance of cash on January 1st. Then the next line, you record your receipts. Next line, maybe you had a disbursement. And it's going to look like our worksheet. Remember the 10-column worksheet we did to do the financials? It'll look a little bit like that. And on maybe 3 or 4 of those columns, you'll have travel. You'll have postage. You'll have delivery. You'll have columns for the ones that you repeat the most. Then you'll have a column called other, where you have to actually write down what the payment was for, okay? Parking ticket or something, and then the money. Once this report is complete, now you write the journal entry. You're not going to record each voucher one by one. What you're going to record is the total of the vouchers that added up to entertainment expense, postage, whatever. Now, what I don't like in this chapter and what I was looking for, but I don't think we need it now. I was going to show you an example of that petty cash reconciliation report, but I realize I may not be able to find it too quickly. So we'll go without it for now. I can put it up on Canvas for you. It's in your book. Believe me, it's in the book. Replenishing petty cash, okay? Now the month ends. The custodian counts the cash, and she counts exactly $10 in cash. That means she should have $190 in unrecorded vouchers. And she adds them up and she says, yep, it's perfect. At that point, you will write a check to her personally for $190. You are going to credit petty cash. Remember, we don't touch the petty cash account ever once it's established. You're going to credit cash, and you're going to go to your petty cash report and post the column totals. That's how you record all the expenses from the petty cash report. Because the petty cash report is not a journal, no posting is done from it, but it's where you do get the source for the entry. A separate entry must be made in the journal. Huh? Now, petty cash replenishment. At the end of the month, the petty cash fund contains 8 vouchers and only $11.20. Huh? The fund needs to be replenished. So we're going to write a check for $188.80. 200 minus the 1120. Everything is perfect. Journal entry. We're going to debit the various expenses and credit cash. That's your entry to replenish. You debit the various expenses off the totals on the reconciliation report and credit cash. And here's your journal entry. Well, you went to your report, you had 40 for automobile, etc. There it is. Everything is perfect. Now we're going to talk about, this will bring us to an end of this exciting chapter here, everybody. We're going to talk about a change fund and use the cash short over account. I'm willing to bet that at least 1/3 of this class has worked in some kind of store where you ran a cash register. Have you ever run a cash register, Lori, at a place? Mm-hmm. Yeah. At the end of the day, you settled up, right? Mm-hmm. At the end of the day, you will count what's in that cash register, and hopefully it matches the receipts and things like that. So let's see what we're talking about. Anybody who works in a cash register knows that you will quite often be off, hopefully just a little bit. It's hard all day. You're running a cash register, you're recording credit card transactions, cash. People are asking for change of a $5 bill. Money's floating all over the place. It's easy to make a mistake. And that's what the cash short over an account is for. A change fund. A supply of currency and coins kept in the cash register cash drawer. This means that at the end of the working day, you remove all the money from the cash register and put it in the bank, but you leave $200 behind. We'll say $200, just to pick a number. When you walk into the store the next day and open up that cash register, there's $200 there. That's called your change fund. At the end of the day, the cash received during the day is deposited and you hold back the $200. Here we go. We start, just like with petty cash now, we set up a new cash account called the change fund. And just like petty cash, we're not going to touch that change fund again unless we want to raise the amount to leave in the cash register. So we set up our change fund. We debit cash, change fund, and we credit cash. We now have 3 cash accounts: cash, petty cash, and the change fund. Well, let's see what's happening here. At the close of its first day of business, there is $1,450 in the cash register, $1,450. The cash from the sales should agree with the sales recorded on the cash drawer. So let's see. We started off with 200, right? We had 200 in the drawer to begin with. We took in $1,450, it looks like. So we should have $1,250 in cash there. If everything worked out perfectly, that's what we would find. And it did in this case. Everybody was perfect. So we are going to record the sales of $1,250. We're going to debit cash for $1,250, and we're going to credit service fees. I don't know what they mean by service fees. Probably service income would be more apt. I'm thinking this is a restaurant, to be honest with you. You know, service menu, you know, selling food is what we're doing here. Okay? So that's not too tough. But there's no way you can run a cash register and not have a goof now and then. And hopefully these goofs are noise in the system and not systemic carelessness or theft. If it is, you're not going to last too long. Mistakes leading to errors. Actual cash is compared. You can end up with too much cash or too little cash. That difference, such as it is, needs to be recorded as a loss or even a gain. And it's going to be done through an account called cash short over, cash short or over. If it has a debit balance, it's an expense. Has a credit balance, a revenue. Lori, what do you think the normal balance of this account is? In other words, assets have a normal debit balance, right? If you were setting this up, do you think we have to call it a debit or credit balance?
I think it might be a credit balance.
Yeah, I like your style. I agree. I'm kind of teasing you in the class a little bit. Yeah, because this thing could go either way. You could say it has a debit balance and it makes no difference in your accounting records. But you are like me. You are a glass half filled kind of person, I can tell, right? So we're only going to end up with credits, revenue here. Okay. Cash short or over. It is an expense account, though. It is an expense or a revenue. Mm-hmm. You know what you could do, which would be pretty stupid if you wanted to be real Sheldon Cooper. You could say we have cash debit account, cash short, one account, cash over the other. That's too much. Oh my goodness, boy, this guy must have really screwed up. Look at this. There's $1,161 in the drawer. We started off with 200. So there's 961 in cash. But look at this. The cash register tape says we sold $963 worth of meals. We are short $2. The cash debited for the amount, that would be the 961. Cash short and over will be debited for the difference and the service fees. And I got to change that to restaurant fees or something. So take a look here. 961, you're off $2. Make sure you understand that the cash register tape, that is your credit to sales. Don't ever make that mistake. That's your credit to sales. The credit to sales should equal the cash. To the extent it doesn't, you got a $2 difference there, okay? $2. I'm going to tell one of my real bad jokes, Lori, okay? And I know you'll bear with me. The CFO, this big vice president of finance, was in a meeting with his secretary at month end, and a guy came through the door on the left side. It was the controller from domestic accounting. He said, "Boss, I got terrible news. We lost $650 million last month." And the boss says, $650 million? Okay, thank you. Door opened on the other side. Guy came in. We lost over $1 billion internationally. Boss says, "Thank you very much. See you later, Johnson." The office manager comes in and says, "We lost $2 in the change fund." And the boss starts raising hell. He starts yelling. Nobody goes home till we find these $2. The secretary's puzzled. And she said, "How come you didn't do anything about the trillion or the million?" You know what the boss said? "Because this I understand." This is controllable, you know? Any number, you up in the millions, nobody knows what's going on. Cash overage. Now here, we found money. We had, at the end of the day, we had 1015. We started with 200, so the cash is this. But remember, the cash register tape is the hard number. That's the one you need to start with. So we're going to credit our restaurant revenues for 814. We're going to debit cash for 815. We have $1 left over, cash over short. And if this happens every day, $1, $2 up and down, it's probably noise in the system, nothing to worry about. But if you see something like once a week, a $40 shortfall, I mean, that's worth investigating. How disappointing that the chapter has ended.
Oh.
And I'm not going to go into the internal controls, not right now anyway, okay?
Okay.
So this was about as exciting as I can make this subject, Lori, okay?
You did a good job.
You have any questions, Lori?
Nope, I think I'm good.
Do you make a motion to end the meeting?
I do.
Okay. All right. You take care, Lori. We'll see you next week.
See you
Okay.
next week.
Bye-bye. Come on, come on. Ooh, ooh.